Saurabh Mukherjea, good morning. Thank you for joining us. So what exactly are markets today reacting to? Weak global cues, governor's resignation, or outcome of state elections?
Yeah, there's such a cocktail. It's such a cocktail. I think it's difficult for us to know what exactly markets are reacting to. Our view at Marcellus is that at a fundamental level, the assembly elections and indeed the general elections really don't have that much of a bearing on the economy. It's, I think, nearly 30-40 years since Indian political parties have had any clear economic views distinct from the opposition's views. However, the governor's resignation, I would say, is more important here. Beyond the confines of Bombay, others in the country might not lose as much sleep about the RBI governor going, but from a financial market participant's perspective, I think the impact on the currency and the 10-year bond yield is clear to see. I think these two impacts, currency and 10-year bond yield, will persist until we have a new governor who's able to instill confidence in the money markets and the currency markets. So I think while the polls might be more dramatic, the far more important change in the last 24 hours is the change at the RBI. And let's see what the next 3-4 weeks bring in terms of New Delhi's perspective on what sort of person they would like at the helm of the RBI.
Okay, last 12 hours rather, we've been focusing on the RBI governor change, but I think the next few hours we're going to be focusing on the state elections, which does look like it's going to be a win for the Congress in some of the key states. Rajasthan, Madhya Pradesh as well is just about neck and neck. Would the market be a little perturbed if we do not have BJP, or rather if we have this entire anti-incumbency wave coming in and BJP loses some of these key Hindi heartland states? Would the markets be worried about that?
I think we've seen Indian markets oscillate to election results. We saw it after the 2004 win for the UPA. We saw it after in the 2009 elections as well. I'm not so sure there's any great deal, there's a great deal of significance in the market reacting to election results, whether it's general election results or even assembly election results. As I said, there's no great ideological difference between the two main political factions in our country as to how the economy should be run. And if you look at India's economic track record over the last 4 decades, growth has improved every single decade versus the preceding decade, regardless of pretty much what sort of government has been in charge. So from an earnings perspective, from an economy perspective, I certainly am not losing that much sleep on the elections. But yes, it could well be that there are some people in the market who've got a certain political view, and if that view sort of gets disturbed by whatever they see today, there might be a bit of a sell-off. But if the Nifty hits 9,500, I'm ready to buy. I think there's enough there in this country to believe that at 9,500 it does make sense to start buying stocks much more enthusiastically.
9,500 is still about 800 points away, Saurabh. So are you saying that you would still be on a wait and watch mode of sorts, wait for more market correction? You don't think that this is still a level at which perhaps investors could start nibbling in?
No, so I think the only 3 sectors I would buy at the moment, the only 3 sectors which I think are beautifully placed at the moment, and I've been talking about the same 3 sectors really for the last 7-8 months, is IT and pharma. I think the rupee will move towards 75, and I think both of these sectors benefit. IT is somewhat understood as that story. Pharma still hasn't had the sort of rally I expected to have, and the well-capitalized private sector banks, who I think benefit from the incipient capex recovery that we are seeing. The RBI capacity utilization data is suggesting that the economy is north of 75% on capacity utilization, and as that kicks in, you are seeing the beginnings of a capex recovery. Well-capitalized private sector banks will benefit from that. These 3 sectors apart, I think it's worth being patient. There is reason to believe that earnings growth is not going to take off this year. There is good reason to believe that the institutional turbulence in our country will hold the market back. So I will be patient on the overall market, barring these 3 pockets that I just outlined.
Right. Saurabh, but in the weakness, since you do believe as an index call that we could sink further 800 points from here, is it going to be an across-the-board fall, or the sectors that you just talked about, IT, pharma, do you think they will manage to hold up, whereas the rest of the market is the one which is going to sink in?
I think where the overvaluation still remains egregious in our country are the wholesale funded lenders, whether they be banks or NBFCs, and B, those elements of consumption in our country which are funded through finance. So cars, trucks, motorbikes, electrical equipment, electronic equipment. So I think there is reason to believe that between financials, auto and aspirationally funded consumption, the bulk of the pullback that we were just discussing comes from those three places. We still have very punchily valued wholesale funded lenders who really have nothing by way of a CASA franchise, whose lives hinge on borrowing in the wholesale market and lending money long term. That's not a model which has stood up particularly well anywhere else in the world, and certainly it's not a model which is worth trading at such a high premium to book value. So I've been steadfast in saying this over the last 12 months, and I'm sticking to my guns there, that there is more of a pullback coming. There's a further pullback coming in wholesale funded lenders, whether regardless of who you have as the RBI governor.
Okay. Saurabh, just before we get on board with the next question, here's DA Secretary S.C. Garg just making his entry into North Block. The visuals will appear on your screen very shortly, and do remember this is of course on the backdrop of the resignation, and there's all rumors about who is going to be taking on the job next of the RBI governor. Will it be a bureaucrat? Will it be an outsider? That's a question that I suppose we should be hoping for an answer for very, very soon. And until then, of course, like we said, there will be a bit of a flux in the money markets for some time, which brings me to my next question. Saurabh, how would you look at the macro setup for the Indian markets at the current juncture? Just a week ago, we had the rupee stabilizing at a level of beyond 70. That's where it had appreciated rather against the US dollar. Yields were a bit stable. Oil prices were down. And of course, now the situation has more or less turned around. How would you look at the macro setup currently?
I think let's break it into the three big parts of the economy. I think on consumption, the FMCG part will be all right. Clearly, running up to an election, there's every incentive for the government to make sure that low-end consumption is shored up by government handouts. But on that element of consumption which is funded through lending, cars, trucks, even aspirational consumer goods, I think there is already a slowdown, and I think the slowdown sustains into next year. Secondly, on the capex cycle, as we were discussing, early signs that the capex cycle is indeed turning. We are seeing that come through in data from the cement sector, from credit offtake in the banking system. So capex cycle, I think, picks up pace on the other side of the general elections, but good positive early signs there. And thirdly, the export piece. I think further weakness in the rupee is a given here, and if the rupee moves towards 75, I think the export sector recovers after about 4 or 5 years of stagnation. So overall, reasonably positive on the economic piece, but incrementally I think one has to be cautious on consumption which is funded through borrowing money.